This video will help you understand how IRMAA works so that you can avoid overpaying for Medicare if you don't have to. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. If you've done a great job accumulating various resources and income streams for retirement, and you've filed or are currently on Medicare, you might get a letter in the mail that says, congratulations, you've done such a good job planning, your income is too high, and now you get to pay more for Medicare Part B and potentially D than most people out there. This additional surcharge, which the insurance companies call a premium, is called an income-related monthly adjustment amount, or a Medicare surcharge for short. So in today's video, we'll walk through how IRMAA is calculated, who it's going to apply to, and then we'll cover some ways in which you can mitigate the effects of IRMAA ahead of time, and even if you get hit with one of those letters today. So let's jump in. Every year, the Social Security Administration publishes new IRMAA tables, which you can find online, and I'll link down below, at least for 2025, that essentially say if your income surpasses these particular thresholds, you will then pay this relative amount more for your Medicare Part B and potentially Part D if you're on a drug plan. As opposed to federal income taxes, which are done on a marginal basis, which basically say if your income is within this bracket, you pay this percentage on this bracket. Medicare surcharges, or IRMAA, is more so akin to cliffs of income, where if your income in total falls into that bracket, then you are assessed this additional surcharge. And in classic government fashion, the more you make, the more you pay. I'll link below to the Social Security Administration's 2025 IRMAA tables, and we're also going to use them in the future of this video to make references as we go through an example. If you already know how IRMAA works or who it's applied to, you can jump ahead to that example, and I'll timestamp it below. In addition, if you've got hit with one of these IRMAA letters saying, congratulations, you make too much money, we'll also cover some ways in which you can fight back and potentially even appeal those decisions made by Social Security Administration. For everyone else, for a quick background relative to IRMAA and how it applies to certain people. The Social Security Administration uses modified adjusted gross income as a proxy for your income to then ultimately determine whether or not you have an income-related monthly adjustment amount. To keep it very simple, modified adjusted gross income is, for the most part, the same as your adjusted gross income number, minus a couple of minute exceptions. And you'll probably know if those minor exceptions apply to you. Essentially, adjusted gross income is all your various income streams added up together, and you can find this number on line 11 of your Form 1040. Whether or not you use a regular Form 1040 or a 1040 SR or seniors, which you can use when you're 65 or older. If you're fully retired and no longer have like a W-2 salary or a 1099 income from being self-employed, generally the things that are going to create your adjusted gross income are going to be things like pension income streams, annuity income streams. Generally, all of an annuity from an IRA is going to be taxable income. Any bond or bank account interest that you get, so think maybe like high-yield savings accounts or money market accounts, as well as capital gains. If you make a big real estate sale or stock sale, those capital gains get added to your adjusted gross income. Now, I'll link above here to how capital gains specifically are taxed, because it's different than ordinary income. But nonetheless, those numbers get added to your adjusted gross income. And then for many of you, your Social Security might be in part or not at all included in your adjusted gross income. To figure out how much of your Social Security gets added to your adjusted gross income for the purposes of calculating your modified adjusted gross income number, you'll have to do a preliminary mathematical calculation called your provisional income or combined income calculation to determine how much of your Social Security check gets added to your adjusted gross income, which then you pay income taxes on. And I'll link above here to an explainer video on how to figure out how much of your Social Security paycheck is drugged back into your adjusted gross income calculation. Income that would not be included in your adjusted gross income would definitely be things like a Roth IRA income stream, because Roth IRAs come out all tax-free. An inherited Roth IRA, of course, that would also be tax-free for the most part, minus a couple of minute exceptions. And then any annuity income streams that are coming from a non-qualified annuity. Generally, there's what's called an exclusion ratio with that, which means a portion of the annuity income stream is taxable income and a portion is tax-free return of basis. And of course, if you're receiving gifts from people, well, those don't get added to your adjusted gross income. Now, based on your tax filing status, that will dictate which IRMAA table applies to you. For most taxpayers out there, there are 5 IRMAA cliffs that you could fall into. But if you are a married filing separately person, then you only have 2 cliffs to worry about. Now, that doesn't mean married filing separately is necessarily a better move just because there's 2 cliffs. I'll link above to my previous video that breaks down some of the pros and cons of married filing jointly versus married filing separately. But essentially, each CLIF has its own related amount of Part B premium increase and Part D premium increase. Now, to keep it simple on us, the Social Security Administration has the exact same tiers for Parts B and D. So you don't have, one tiering structure for Part B extra premiums and then one tiering structure for Part D premiums. Essentially, if you make this certain income, your Part B goes up by this much, and Part D, they're the same brackets. So far, so simple. If your modified adjusted gross income falls within particular CLIFs, you'll pay that particular CLIF's amount more for Medicare Part B and D. But in classic government fashion, it can't be that simple because it's actually a little bit tricky. And that's because the 2025 IRMAA tables that are pushed out apply to the income you made in 2023, or whatever your 2023 tax return says you made. So essentially, the Social Security Administration is going to look back 2 years to then determine whether or not you fall into the 2025 thresholds and then charge you an appropriate amount of income-related monthly adjustment amount. So it would be incorrect to assume, okay, my income is pretty low this year, I'm not going to get hit with any IRMAA charges because it's actually going to be based on your income from 2 years ago. So you're always going to look back 2 years to do the math for what applies for this year. Proactively, the implied effect here is that you should always at least be planning 2 years ahead of time, saying, okay, whatever my income is this year is going to fall into the 2027 IRMAA thresholds, and I therefore need to plan ahead of time. Now, I say 2 years, but it's possible they could look back 3 years if you don't have, the tax information from 2 years ago. But for most people out there, if you file your returns on time, or at least within the extension to October, then they're going to look back 2 years and then base your current year IRMAA based on whatever it was 2 years ago. Now, you might be thinking, oh, okay, well, that's a little sneaky that they're going to look back 2 years and try to catch you off guard. And that might be the case, but more realistically, it probably just has to do more so with how able the government would be to turn around how much you have to pay an income-related monthly adjustment amount based on your current tax year's income. Because, for example, in 2025, the Social Security Administration won't know what your 2025 income is until April 2026 at the earliest and October 2026 at the latest. But even if they look back like 1 year and said your 2025 IRMAA is going to be dictated based on your income in 2024, well, theoretically, they wouldn't have that information until October of 2025, which means they have, 2.5 months to then charge you the appropriate amount for this calendar year. And they have to do that with the 66 million people that are on Medicare. Probably not going to happen. I'm sure looking back 2 years is probably the closest possible they could make that window to where they can accurately apply income-related monthly adjustment amount to taxpayers. I suppose they could theoretically make things on like a quarterly estimated basis, kind of like how you're supposed to file your taxes, or at least your employer is supposed to report taxes at least on a quarterly basis. But I imagine getting a bunch of seniors to do that is probably not the best use of the Social Security Administration's time. Either way, let's walk through an example using the thresholds for 2025, which means we're looking back at your income in 2023. Let's take a married couple who filed jointly, and let's say they're trying to estimate what their IRMAA would be for 2025. Let's pull up the IRMAA tables for 2025, and again, I'll also link them down below. So how are we supposed to read this chart? Well, first and foremost, for 2025, the Medicare Part B premium is $185 per month per beneficiary. And beneficiary is just the technical term for who's benefiting from Medicare, aka the people that are on Medicare. So for a married couple filing jointly, both spouses would have a premium of $185 a month, which is $360 a month in total. So how you would read this chart, for example, you would ultimately figure out what was my modified adjusted gross income in 2023, and then figure out into which bracket does that apply. Then you can see it dictates what your Medicare Part B premium is now, and it wouldn't be $185 a month if you fall into one of these brackets. In addition, whatever your Medicare Part D premium is for your drug plan, you get to add a couple extra bucks onto that as well. So let's say in 2023, this couple who does married filing jointly made $300,000 in modified adjusted gross income. So in this example, the couple making $300,000 would fall into the second bracket, meaning their Part B premium would go from $185 a month to $370 a month, which added together is $740 per month, which is a sizable chunk of change when you add it up throughout the year. In addition, their Medicare Part D is going to cost them an additional $35 a month, which added together is another $70 a month. So is the surcharge on Part D going to massively break the bank? Probably not, but Medicare Part B absolutely could have an effect on someone's cash flow, especially if they're on a fixed income. Now, the Social Security Administration does permit you to fight back if you receive a letter in the mail, but to your mind, things have drastically changed from where you were at financially 2 years ago. Specifically, they refer to these as major life events, things like death, disability, or a drastic reduction in income. Well, one drastic loss in income would be your retirement. Using SSA Form 44, which I'll link below, you can actually fill that out and send it back to the Social Security Administration and say, hey, my situation has drastically changed and I would like you to waive income-related monthly adjustment amount surcharges because things are totally different. And in fact, one of the checkboxes on that form is work stoppage, aka retirement. Now, if that fails, for example, and Social Security Administration comes back and says, nah, you're still going to pay IRMAA, you can appeal that decision a couple more times. There's actually Tier 2 and then a Tier 3 appeal that you could do. Now, as you escalate in tiers, things of course get more complicated and more time intensive, and you might need to hire a professional to help you with this. And so it may or may not be worth the trouble. If you look at your implied hourly rate as a happily retired person, it may or may not be worth all the time, energy, and effort that would go into appealing that decision. You might just find more peace of mind in dealing with the extra charges. But if you want to fight the fight, you totally can. There's different levels of appeals. That's beyond the scope of today's video, but I'll link below to how those appeals would work if you want to have some more information. So from a calls to action standpoint, in preparation for eventually filing for Medicare, you would at least, starting in age 62, want to start proactively planning out how you are going to keep your income low in retirement. Now, does that mean you should not live the retirement of your dreams just because there might be IRMAA costs? Absolutely not. However, if there are some things you can do proactively ahead of time to set yourself up for success, I'm all for it. One of the proactive strategies our office has taken with clients, and generally this is before Medicare filing age, but it could even be in Medicare filing age territory, would be things like Roth conversions. And Roth conversions have a two-pronged effect on IRMAA. Number one, of course, any money you pull out of a pre-tax environment and move to a Roth environment is pre-tax money that will not get hit with required minimum distributions once the taxpayer is in their mid-70s. So it decreases future RMDs. The second major effect it has is now you have more tax-free income in retirement. So when you are trying to bracket out, which income sources am I going to turn on in retirement, you have a tax-free income source, namely a Roth IRA, that would allow you to pull money out, pay all your bills, live a great retirement, but not negatively affect you by way of calculating IRMAA. Now, even if you're already on Medicare, it's not too late to plan ahead of time. There are a couple things you can do on an ad hoc fashion to ideally lower your modified adjusted gross income so that you don't get hit as bad with IRMAA. Number one, you could look at doing things like capital loss harvesting. This is also called tax loss harvesting, but essentially it's where you do not generate capital gains in your portfolio and instead try to generate losses on purpose. I'll link above to an explainer video on how this works, but essentially what you're trying not to do is generate a bunch of capital gains. The other thing you could look at doing are qualified charitable distributions, and I'll link above to an explainer video on that too, where essentially rather than take your required minimum distribution out of your IRA and then having that count towards your modified adjusted gross income, you would rather just donate your required minimum distribution to a 501c3 nonprofit of some kind, and that allows you to not include that income on your tax return, but it also lets you do something charitable, which of course if you're charitably inclined, this can make a lot of sense. It's far more efficient than taking the required minimum distribution, paying income taxes, and then donating that later and trying to itemize those tax deductions. So hopefully that was helpful. If you have further questions, drop them in the comments below or get to the website. We'll help you get squared away. Have an awesome rest of your day. We'll talk to you later. Bye.